the biggest mistake owners make before talking to you?
It's an interesting question.
What do you think are the biggest financial fires that owners don't even know they're starting?
And there's really no right or wrong answer. They're so ingrained in working day to day on the company.
What size businesses do you work with in terms of annual sales?
I mean, we have some that are in the billions. We have some that are in the low 10 million. We tend to look at it more on like an EBITDA perspective, right?
Welcome back to the Financial Firefighter, the show where we help business owners stop the burn before it takes them out. I'm your host, Randall Turner. Every week I sit down with people who see the fires burn that most people don't. The ones who understand money, markets, and the real pressure behind the scenes. My mission is simple. Give you clarity, confidence, and tools to keep your business alive and thriving. Today, I'm joined by my good friend, Jamie Miller. Jamie's a investment banker for UBS. Let me read you his pivotal statement here. Jamie Miller serves the pivotal role of advising business owners, entrepreneurs, executives, and private clients on wealth planning, transition strategy, and legacy design. He leads the team's strategic efforts by leveraging UBS's global resources, the complex and evolving need of ultra-high net worth and high net worth clients. Let me tell you what Jamie really does. I've worked with the man for years. He fixes things just like I fix things, but he has a great vantage point, and he comes with a lot of power behind his name here. The fun part, I'll let Jamie tell you. Jamie, you've got 3 children. What are their names?
So Georgia, Lane, and Knox.
And you have French bulldogs, yes?
Howard Hughes and Sausage.
Howard Hughes and Sausage.
Patty Miller, if you want to follow her on Instagram.
Oh, really? I didn't know it's so famous. Well, Jamie and I have worked for a similar client and a lot of other clients, and he's got insights. Let me start with hopefully the simple one here, Jamie. What's the biggest mistake owners make before talking to you?
Well, first of all, thanks for having me, Randy. It's an interesting question because it can be a loaded question. I think the number one thing that we see is that business owners are not generally preparing for
the transition. And whether that transition is to a family member, to key executives, or to an outside sale, most are not thinking about what that transition is going to look like. And so kind of what we help people think about from both a wealth planning and an exit strategy is what do they work their entire lives for, right? Is it to build a company, then be able to pass it to their kids? Is it to pass it to the key executives? Or is it to truly,
build a company to sell it and have that liquidity event? And there's really no right or wrong answer. But I think a lot of clients don't think about it that deeply. They're so ingrained in working day to day on the company, and that's what they should do, right? But I think that's where having a really good team of advisors, whether it's the wealth advisor, the CPA, the attorney, the exit planning advisor, whatever that is. And frankly, exit planning should be done every year, even if you have no intention to sell, right? I mean, at the end of the day, you should always be preparing for what that succession looks like. And that's kind of, some of the stuff you and I have worked on, of just understanding the books, understanding what the expenses are, understanding what the receivables look like. I mean, there's so many things that go into it. And the one thing I'm always amazed about, a lot of business owners know what their net income is, but they don't know what their EBITDA is. So when you start to look at things, EBITDA is how we trade, right? That's how businesses trade, whether it's to internal people, external, even to the family. Obviously, there's some discounting you can do from a pre-exit planning that helps from a tax perspective, but understanding EBITDA and then the multiples of that industry, right? Every industry is going to be a little bit different. It's really important. And again, whether you're actually going to exit in a year, 10 or 20 or 30, right? Looking at it, on a year by year basis, quarterly basis, just understanding what the business is doing, how it's operating, I think is super key to their own personal wealth strategy, right? That's the biggest part in my opinion.
So what do you think are the biggest financial fires that owners don't even know they're starting? Let's put it that way.
Yeah. I mean, one we see a lot is acquisition wise, right? And growth reasons. Like, what are you trying to do from a growth perspective? Like, if you're going to do an acquisition, what is the reason, right? Is there, are you trying to grow the bottom line business? Is it because you want to have a new line of business that you weren't necessarily in? It seems as though people, when they see something that they want to purchase or something that they want to do, they're not really thinking about it that way. And then from an expense perspective, right? Like, a lot of people have their family being paid out through the company and things like that. So if you're truly going to exit at some point, right, we talk about recasting EBITDA, looking at the numbers, trying to maximize value underlying. If you're within 5 years of exiting, whether it's to the kids or whatever, like, that's something definitely to consider.
Okay. So how do really good businessmen and women make it different, do it differently? Let me put it that way. Because we all kind of seem to know the same routine. And, we go in the morning, it's the usual routine. And if we got an accounting staff of 1 or accounting staff of 100, they're just kind of left to their own devices, it seems, until something really happens. So,
I mean, the biggest thing we see is working in the business versus on the business, right? I mean, at the end of the day, if you're working on the day-to-day so much, it's very difficult to focus on the overall strategy of the company. And again, there's a lot of super successful business owners that are just grinding every day on the day-to-day. But from the most successful people, and this is where private equity, right? People, they kind of get a bad name sometimes with private equity, but the one thing that private equity does the most is focuses on the business and not necessarily the day-to-day. They hire the best people to operate the business, and the owners and those people are really working on strategy and growth and how are we going to do that. And so every day that those people show up, and the most successful entrepreneurs that have built a business pretty large and exited at some point, they've kind of transitioned from working in the business to on the business.
well, we want to back up a little bit. What size businesses do you work with in terms of annual sales?
It's really fluid. I mean, we have some that are in the billions. We have some that are in the low under 10 million. We tend to look at it more on like an EBITDA perspective, right? So if the EBITDA, every business is different. So profit and margin is a big deal. So from our perspective, from UBS investment banking and kind of our one bank platform, it's usually a 3 million and up in EBITDA, but we've created some really good relationships with local M&A advisors that can handle anything from 500,000 to 3 million of EBITDA. It just very much depends on the business too, right? The tough part, if you have a 500 or $1 million EBITDA business that hasn't been growing, right? It's going to be to transact or even do the planning, right? Like if the exit, let's just say it's 3 to 5 times instead of 7 to 8, right? Like obviously the financials are a little bit different, but it's truly understanding the business and what the people are trying to accomplish. I wouldn't say there's any right size, but our kind of bread and butter, I would say, is like that $3 to $20 million EBITDA companies that are just over $1 million. And we've actually helped them do incredible exits. And I would say from an exit planning perspective, 2+ years out is the proper way to start thinking about it. If you get it, I mean, as you know, with some of the planning, like if the patriarch or matriarch runs the company and they pass away early and they were unexpectedly, right, and they haven't done a lot of the pre-planning, that can obviously create a fire sale, which we don't want to ever have happen. So it's just kind of always being on top of it and understanding what the strategy is long term.
Gotcha. You don't need to tell me names or locations or anything, but what's been the biggest success you've seen with businesses? I mean, going from tiny to big kind of thing. What's really instrumental in making that happen?
I think it just still goes back to growth strategy, right? It's what do you want the business to look like? We have one locally that we're working on that, frankly, I think can go from 100+ million of sales to over $1 million. The question is, does the person want to do that, right? They may not want to. In that specific situation, you're probably going to have to take on some type of partner to truly go out and make some acquisitions, right? There's organic growth. There's growth through M&A. But when you see an opportunity in certain industries, right, we get this a lot where people go, oh, private equity's in every industry now and there's no opportunities out there. I don't believe that's true at all. I mean, we see it all the time where you have a really cool business. There's one you and I are working on separately that is over $1 million of EBITDA. And I think in 3 years, I mean, it could be 3 to 5, right? Just with the right strategy in place. And so that's not a big company, but that's a super exciting company, right? You look at an opportunity and you go, okay, this is one area private equity is not in yet.
Yes.
There's a massive thing there. And the question is, does the owner want to do it? And whether that's bringing on a partner to do it with, right? And that could be a second investor. It could be a family office. It could be private equity, right? There's still a lot of opportunities out there. There's a lot that can be done, and it's just a question of what is some.
Okay, but how do you make a difference, though, personally, in that?
Honestly, it depends on every single owner. Like right now, a couple of the companies, we are bringing in people for them to talk to about how they can potentially grow. And that might be an investor. It might be just a new COO. Right. Somebody that, like, going back to working in the business versus on the business. A lot of guys or a lot of company business owners maybe work too much in the business. So hiring the proper people to kind of help with the day-to-day and then grow from there. But it all comes back to, like, what is somebody trying to accomplish?
Mm-hmm.
Some people go, I have a lifestyle business. I don't want to grow. I make enough money.
That's a lot more common than I thought, frankly. Whereas,
unbelievably common.
Yes. I learned the hard way that business is not necessarily about business.
Right.
It's about egos and politics and family and big toys.
and suddenly you lost the way.
Yeah, and family creates a lot of dynamic too, right? Bring the kids into the business. The goal, right, is first generation starts the business, second generation builds it, third generation screws it up, right? I mean, I think it's only 4% of third generations actually are successful in continuing the business going. So if you don't have a true plan in place and you haven't brought the kids into the fold, I'll give you an example. I have a family that I work with out of Long Island. Part of their family charter is that the kids cannot come into business for 5 years after they graduate college, but they have to go work in a similar industry, right? So they have to go get real world experience outside of the family business to learn about how the business works and operates. And if after 5 years they want to come into the business, then they're allowed to. But before that, they cannot come into the business. They have to learn the business from a different perspective, right? And then they're able to come back in. So there's so many things that go into it. There's no one shoe fits all for everybody, right? Everybody's situation is different. Like we deal with a lot with financial planning. People are like, well, what do I need to retire? I'm like, well, what do you need to live off? Like,
like what are you living on now?
Let's live off 40 grand a year. Like you could retire pretty early, but if you need $200,000 a year after tax, like, well, we have to have a sizable enough portfolio to justify that. And inflation depletes your purchasing power either.
Oh, exactly. It's when I get a kick out of it times. I dealt with a manufacturer last year. We'll leave names out, but he was doing fine. He made good money. He owned it for many years. And then when he went to try to sell it, his earnings, his EBITDA didn't look too swanky. And then you start normalizing the earnings, and you find out, he's taking $2 million a year out just to take care of his farm. Oh, okay. So that
makes
a big difference.
Know that, and then you find that out. You're like, okay, well, we got to take that out, right? Like for the business perspective, like that's fine to do, right? You have the ability to do that. You can do that. But from a true planning perspective, it's probably not the best way to exit, right? If you're not going to exit, I guess it doesn't really matter. But back to what we said at the beginning, like you're going to exit at some point, whether it's to your kids,
right,
party, right? It's going to happen.
Or ESOPs.
Or an ESOP, right?
But I have a feeling, okay, people are probably a lot like me when I first started learning about ESOPs. Can you give me like the brief highlights of what an ESOP is?
Yeah, so it's a twofold, right? So let's just say you have a company that you don't really have a true successor, or frankly, somebody that can actually buy it from you, right? So you've built a good business and, you have somebody that they could run it, but maybe they don't have the capital to do it and they can't go get financing. So you can go into an employee stock ownership plan, which is what an ESOP is. We have a great team at UBS, Nick Francia and Keith Apton, who we work very closely with, who kind of help with, I would say, every piece of the ESOP. We start with the valuation, right? We bring in an investment bank, we bring in the CPA, the attorney. But a lot of owners may not know what an ESOP is, but they've probably heard of a 1031 exchange for real estate. It's very similar. You're in essence trading your business stock for stock in an ESOP. That transaction, if done properly, is tax-free to you. And so when you look at a valuation, let's just say you hired an investment bank and they come back at 4 or 5 times EBITDA, and you look at your math and you go, okay, that's like, if I exit, I have to pay capital gains tax on this. I'm not really netting as much as I want. We see it a lot with, construction, manufacturing businesses where, they have a lot of inventory, they have a lot of equipment, right? And that value of the equipment can be as much as the business could sell for, right? So then you're looking at an asset sale instead of necessarily a stock sale. An ESOP gives you an opportunity to sell to this ESOP. You have an ESOP trustee, but then every person at the company becomes an owner. There's been some extremely successful ESOPs who continue to grow and have gotten very large. But where it comes down to is when you run the valuation and then you look at it from a tax perspective, let's say you're getting 5 times on a transaction externally, you might get 5.5 times on a valuation for an ESOP, but your net effective rate that you're getting, it would be like 8 times if you sold it to a third party. So you look at it that way. And if you truly want the business to succeed long-term and you have really good people that you want to take care of, it's a great way for you to exit, get your capital out. You can stay working, right? You don't have to be done. But it's a way that you can kind of realize the value on your life's work.
Let's go back to you a little more. You might even taught me this years ago in terms of borrowing money from myself to fund my own operations.
Yeah.
It's a much better deal. Can you explain that a little better?
So it can be a very good strategy. We've done it a lot with business owners. We've actually done it a lot with real estate professionals. So If they have a liquid portfolio, so whatever your financial advisor, whatever you have, firms like a UBS will offer different types of lending opportunities. So for us, it's called a securities-based loan, an SBL. You're able to borrow. Sometimes we have fixed rate loans at 1 year, 3 year, 5 year. We had one at 10 years at one point. But if you look at that compared to like a commercial line of credit might be, SOFR plus 3.5%, 4%. Sometimes on the fixed, it's actually below SOFR. So you can fix it at that rate. You pay an interest only on the debt, and it's super fluid. You can pay it off when you want. You can keep it going if you want. Where it comes in a lot with the real estate guys is, let's just say hypothetically, when you look at real estate and you look at your cap rates, right? The more leverage you can create, can create more cash flow for you. So, they potentially will even use our securities-based loan as similar like mezzanine debt, right? Rather than going to a mezzanine lender at 12, 13, 14%, or even like some real estate professionals will do like preferred debts. They'll sell, debt to a consumer at 15%. Well, if you can borrow from yourself at 4.5 or 5, I don't know why you borrow at 15, but
Exactly.
good portfolio gives you a lot of flexibility. So from a, personal financial planning, right? And we see it a lot with companies that are successful and maybe they're growing, but not growing as much as they would like. They always are reinvesting back in the company. You take a dividend, you start investing that on the side. Now you have two portfolios, right? You have your liquid portfolio, you have your liquid business. It gives you more flexibility of things that you can do. Not to say it's the right answer for everybody, but we have seen it used a lot. The team has over $400 million in securities-based loans that are super flexible, right? There's a lot about private credit right now. The reason why people go to private credit lenders and pay a higher rate of, higher rate interest rate is because it's flexible. It's way more flexible. So people always ask that, like, why would Google do a private credit facility versus underwriting a bond? Because they can do it quick and easy. And if they don't use it or they use it for a short term, they can pay it off. There's not a lot of penalties that come with that. So it's a cool strategy to understand. It's like I said, it's not right for everybody, but I think in the right process with the right CPA, the right attorney, it can be a very powerful strategy.
Makes sense. What other misunderstandings do you see about debt being used by business owners versus equity? Little pop quiz there for you.
Yeah, the tough part with giving up equity, right, is if you're truly growing, people don't want to miss that upside. The counter is where debt, I think, is valuable is more on, acquisitions, right? Like if you truly see a company that you really want to purchase, like debt is not like this big deterrent to growth. But you have to be willing to grow, right? And if you're just going to borrow debt and there's no growth plan, like probably not the right way to go. But like going back to private equity, I mean, every private equity deal you can leverage, right? I mean, they might only put 20 to 30% of capital down and they're using debt to fund the purchase. And so that's where private equity, where, people might say, they get a bad name sometimes because, they really are growth focused, but, the best PE firms are not going to buy a company unless they can 3 times their money, right?
To set the number.
They don't believe that they can do that. They're probably not going to buy you.
Gotcha. Yeah.
If you buy a company at 10 million, you only put 3 million of cash in, right? You use 7 million of leverage and you grow it to 30 million. Right, on your $3 million investment, and you let's just say you paid it down to 5 million, so you have 8 million in, you pull out 22 million on a $3 million investment. Pretty good.
Yeah, that's a return. Makes sense. Okay, back to my struggling business owners. No names, but what's the dumbest move you ever seen a business owner do when they're under pressure?
Probably a fire sale because they weren't prepared. Something happened, somebody passes away, there was no planning pre that at all. The family gets it, they don't want it, right? What do you do with it? I mean, the other thing I would say is, back to acquisitions, making poor acquisitions potentially, seeing an opportunity because somebody in their industry is struggling and they think they can buy it for, a low number. And then once you buy it, you realize there's a reason why it was struggling and there's really not a plan to integrate that business into your business, right? I mean, the biggest thing with a business owner, if you're successful, you've done an incredible job of creating a strategy for the company and you think through that. Integration is hard. And that's like, I think the biggest mistake on transactions where people are buying companies is they don't necessarily have a great integration plan to bring it into the fold of what that business does and how it operates and how they think. It's again, look in the mirror, realize why you've been super successful. And if you don't think you can integrate that company into your company to act like your company, like probably not the best deal to make.
That makes sense. What's the funniest conversation you ever had with a business owner, or even the most awkward one you ever had with a business owner?
What always gets interesting with divorce.
I bet it does.
I mean, you hate to say it, what is about 52% of all marriages end in divorce nowadays. I think that of like, how do I shield the value of my company from, my spouse? I mean, it sounds bad, but it happens a lot.
Yes. Well, I was thinking
It's on the other side of divorce. Make sure you hire a pretty good, forensic divorce accountant or a good attorney to make sure that they understand the true value of the company.
True. Yeah, I saw one the other day, and the business valuation was way down here, and it made no sense to me. And then you start thinking, who did they hire to come up with that valuation? I've seen the inverse of two. The way up here, and it's like, okay, let's get reality. Those are the fun wake-up calls to owners.
I have a good friend, Dave Dorada in Buffalo, whose kind of forte was doing valuations through marital issues, and that's always one of. I mean, some of the stories you hear from him are interesting, but that's a big one. Just understanding what the actual value of the company is when you're going through that. Hopefully, you have a prenup and you can kind of work around some of that, but a lot of times people don't want to have that conversation.
I'll tell you one cute one I had a number of years ago. Had a good friend who suddenly died. He was about my age, and so it's a very sad situation. And I met with his family a few months later. Middle America business. They're doing just fine. Owned it for years. And I said, okay, if one of the other family members dies, do you have like a key life insurance? Do you have some way to pay for buying out the partner's spouse, whatever? And I was pretty much pat on the head, told, leave me alone. I don't sell insurance. I had no vested interest. I just wanted to see them do well. And it wasn't 3 months later, the other family member just killed her from a heart attack. And then it got really interesting because there was no funds to buy him out, and there was no agreement. It got hung up in the courts for year after year after year. And the surviving partner went to his relative's house to pick up one of the company vehicles. They called the cops, big scene, the whole bit. And you think, also what it's taken is, here again, I don't sell insurance. Somebody with that kind of brain set to sit down and then get a good lawyer. And they could have fixed it all in a couple of days sort of the time, and a couple $1,000 or less. And instead they wound up with over 3 or 4 years worth of hold up in the courts and mess.
I'll give you another one. This is a while ago. This is probably 10, 12 years ago. We had an attorney that brought us in on something that really successful family business. The patriarch did not want to do any estate planning, thought if he did, he would die. Well, guess what? He died. Business was super successful and kids were in the business. And with that comes a large estate tax, right? There was no insurance. There was no life insurance, no irrevocable life insurance trust or anything like that. And so the kids get hit with a $50 million estate tax and there's no money to pay it. So now you got two options, right? You have to borrow to try to pay for that estate tax off the business, right, off those assets, because there's not enough assets outside of that to actually be borrowed against to fund it. They ended up becoming successful with it because they had a really good son that ran the business and figured it out. But, it created some issues because the family, there were multiple kids and only one in the business. And the kids thought they were going to get a check from, the business because dad, they all, were going to share a part of it. I'm like, well, with the estate tax, the business is technically worth nothing now, right, on paper. And so thankfully they clawed out of that. But, that's where proper planning comes into place. Like, and that's the thing too, people going back to EBITDA, if you think that your net income's $5 million, your EBITDA might be 7 or 8. Well, especially in New York, we're in the state of New York, they're going to come after you for everything. Well, that could trade off 6 times earnings. And now you're over the federal exemption and the state exemption, and you had no planning and there's no liquid assets. That's where the fire sales come in. Like, we have to sell the company just to pay the tax. Like, does anybody want to leave their kids with that? I mean, or their wife or their spouse, right? Like, nobody wants that.
Yeah, but that's part of my father's generation. My father had a rather successful oil company and hundreds of oil wells, shallow, but hundreds and all that kind of bit. He never told my mother anything. He never told anybody anything. It was all between his ears. And then one day he died suddenly. And, and what a mess. And my grandpa owned even more than my father. He owned just tons and tons of stuff. And my mother wound up being the executor of 2 estates at the same time. And she was more than overwhelmed, totally unprepared. Mom's highly intelligent, but she's a teacher. This is so out of her realm. So the planning part is something you want to see more of. Hey, by the way, tell me if you're seeing this. I'm seeing hearing more about the bankers, commercial bankers, are now requiring written succession plans in order to keep your business's line of credit. Is that you seeing that?
I mean, think about it, right? Like, let's just say hypothetically you have a 55-year-old plus person and they're looking at the company and it's a big, to your point earlier, but a big key man risk. A lender wants to know, like, what happens? And if I can't get paid back on my credit, like, I can't underwrite it. And that, going back to private credit, that's why private credit has become such a large industry, is because, banking regulations post-Dodd-Frank have gotten a lot more stringent. And frankly, the banks need to. They need to protect their investment in the company, right? But yeah, I mean, if you're the lender, you want that money. I want to know I'm going to make sure I get paid back one way or another. If I don't have a good plan, I'm probably not going to lend to you.
Right. The other thing I'm seeing all of a sudden is debt covenant. And I've not seen enforcement of debt covenants since the last debacle in 2008 and 10. Yeah. Am I alone in that, or are you seeing that too?
We're seeing it too.
So what does that tell you about the health of the banks or the health of the economy?
I actually think the banks are strong.
Okay.
Especially if you look at earnings from the Q1, I mean, banks have done extremely well. If you actually look at the financial sectors, we own the financial sectors ETF. It's actually not performed that well this year, but banks have been, knocking earnings out of the ballpark. I mean, some of that's trading, some of it's investment banking. It's definitely, the environment right now is more pro-business than it was probably in the previous administration. Not to get political, but whatever you think, it is what it is. Like, right. But I do think that the banks are very strong right now. And frankly, because of that, they're not being forced to give away money, right? Like, they have to be really diligent in how they deliver capital. But I do think that's where private credit has kind of had this boom. And obviously this year, been a lot of noise about it. I mean, we have one private credit fund that we invest in that was in the news a lot, and they had to sell $1.4 billion of debt in January, and people were saying that the debt's worth 60 cents of the dollar. Well, they sold $1.4 billion at 99.8 cents on the dollar. It tells you that the underlying companies that they lent to,
strong. Yes.
So listen to the noise is important, right? You have to pay attention and you have to look at that. But the underlying companies that they lend to, there are some that have not done well. Luckily, knock on wood, we don't have them at UBS, but I think that's where the marketplace has changed. If you listen, like Jerome Powell talked about it in March, that he does not see a systemic issue in private credit. But I think that's where that business has really boomed, is because the bank's ability to lend has become much more stringent. And I don't necessarily think that's a bad thing for the bank's balance sheet, right? At the end of the day, the bank has better credit on their books, going to make them look a lot better. But that's where people then have to go find alternative financing.
I got a little rapid fire round here. I don't want big, long answers. Maybe you can just give me like a sentence or so.
Oh, you saying that to you too much?
Never. You can't have too much fun.
All day, you know that.
Okay, here's your first one. What's one financial habit every owner should adopt? I mean, you have a unique vantage point because you're not there every day. You walk into dozens and dozens of businesses. What is it? What's the one financial habit though every owner should adopt to necessarily get?
But it actually is.
Okay, I'll go with that. So what's the one habit they should adopt?
Again, I think it goes back to what I said earlier, like working on the business versus in the business. It's understanding the business as a whole.
Okay.
What are the goals and what are you trying to do?
Debt, friend or enemy?
Depends. Can be a great friend if it's for growth.
Okay. Equity.
You got to be very careful.
Equity, is it misunderstood or overused?
I wouldn't say it's overused. Misunderstood in how you go about it and who gets what. You talk about phantom equity and ways to incentivize people underneath you. I love equity. I think equity is like the king that makes everything, right? If you have equity, you can do a lot with that. But I would think equity is super important.
The smartest question to ask someone in your ring. So in other words, me asking you, what's the smartest question I should ask you as a business owner?
As a business owner, what are your goals? What are you trying to do? I mean, it's simple. It's so easy, but I feel like that's such an open-ended question that once they start talking, you can then drill into other questions. But it's very difficult. You never want to sound like you're talking down to a business owner, right?
Mm-hmm.
They've obviously created a great business, and I think the goal is to try to help them figure out the value of what it is, back to whether it's going to the kids or outside or employees. It's just understanding, what are you actually trying to do here? Back to like a lifestyle business. If that's the answer, that's fine. Like, there's nothing wrong with that. Like, you work so you can do the things you like to do.
Absolutely.
And that's fine. But I like to work with people that want to grow, frankly. The people that are just happy with the status quo, it doesn't really excite me. So,
Okay. And one sentence of advice to an overwhelmed business owner.
surround yourself with good people. I read a piece that a friend of mine, Sean Baker, sent me from Rochester a couple of months ago that a family office created for him. And he said, specifically, if you do not want to have a beer or sit to dinner with any of your advisors, whether it's your financial advisor, CPA, attorney, probably not the right advisor for you. And so if you work with people that you like and that you trust, you can kind of talk about anything, right? And you want to have that, again, in a business, a lot of business owners don't even want to talk to their CFO about what their strategy is, right? They want to talk about the numbers. They don't really want to get into that. If you have really good people around you that are good connectors of other people, I think it can just drive massive value for you. And frankly, just having another support system that's outside, it's actually something better to have somebody not in the business, right? That they communicate about this stuff. But if you're not willing to have a drink with them or want to sit them at dinner with your family, like, probably not the best person to work with.
Okay. Well, makes sense. That makes sense. So what is the last bit of advice you give to somebody? We can look at it two ways. My forte anymore is rescuing those struggling businesses and finding them capital, all 9 yards. On your side of the spectrum, what's the biggest mistake you see people making with money to invest?
Not having a plan. I mean, honestly, I think people, like, back to focusing so much on day to day. It's like, what is the actual goal here? If there's not a plan set up, like how we invest, right? Like, and I say this to anybody, like, if we don't run a financial plan for you, how can I truly make investment recommendations to you? If you have no plan, like, I can just put you in a bunch of growth equities and see how it does. But if maybe you don't need as much growth and you want some more downside protection, right? That's all going to come back to the plan of, like, what are we trying to do here? And for you individually, your family, your legacy, right? And we're talking about the 3 buckets: your liquidity, your longevity, and your legacy. Like, we're trying to solve all 3. And so an investment plan is really imperative back to what your own personal plan is, right? Like me, I own no fixed income, right? I own all equities and I own private investments. Like, I love it. I don't mind the risk. If the market goes down, I'm putting cash in, right? I believe in it over time. At the end of the day, when you buy equities, right, you're buying businesses, right? So business owners should feel comfortable investing in other businesses, right? At the end of the day, if they understand a business, right, that's where you can feel comfortable investing in them. And so our job is to try to find the best businesses to buy. And generally, I mean, it's like Warren Buffett, right? I mean, his whole thing was buy good companies and wait.
And wait. Yes.
Just let them do what they do. And if we do, a new CEO comes in or whatever, we don't like that guy, we don't like his strategy, then we sell it. And if you have to take a capital gain, so what? You made money. Like, that's a good thing.
And I can attest to your wonderfulness at this. Returns that you provided one of my clients last year was quite, I don't know if to say stellar, but I was better in market. It was pretty awesome. So you're very good at what you do.
Asset allocation is a big thing too, right? Like, if you didn't have international over the last 18 months, you didn't perform that well. If you weren't overweight growth at all, you didn't perform that well. But if you looked at international for the last 10 years, it didn't really do a lot. So we have to be strategic in how we do that. We started adding international in January of 2025. Knock on wood, it turned out great. Even talking about Iran right now, like, people are worried about the global supply of oil. I mean, international is the best supporting or best asset class this year. At some point, if this, war becomes elongated and oil really becomes an issue, like, at that point, maybe we'll trim that position. But, I think that just being able to understand, like, what the market's telling you, and you never want to be first either. Like, there's one hedge fund guy who's originally from Buffalo, Charles Stevenson's his name. I read an article about him from the 70s. He said, do you ever go to the beach and wait for the waves? No, you will not. You wait. And then if you see that day there's going to be waves, then you go out. But, like, you never want to be the one sitting there waiting for the waves. Which I always thought was kind of.
It is. I think you're pretty cool. Jamie, this has been outstanding. appreciate your clarity, your confidence, and your real world insight, which you definitely have. I think it's what business owners need right now.
Yep.
And to everyone listening, remember, fires don't go out on their own. Keep your eyes open, keep your cash flow tight, and keep fighting for your business. Randall Turner, the financial firefighter. Jamie, what's the best way to get a hold of you?
You can Google me. We're online. But I want to give you a little bit of a plug here too. I've worked very closely with Randy the last 5, 6, 7 years, and back to finding people that you want to do business with, like back to the beer thing. Just didn't have a beer with them, but we were talking a little bit before we got on the podcast, and I think the biggest thing is working with somebody that's coming with new ideas. It doesn't mean that every idea you're going to implement, but one thing that I love talking to you about is new ideas and how to potentially implement them. And, I think being intellectually curious of what's going on out there, I think is unbelievably important. And you want to have somebody that you can sit and have a drink with, but also talk very deeply about things and trust. And that's something that you are extremely good at. And so I always want to thank you for being a good partner of mine.
Thank you, sir. So very, very nice of you to say so. It goes likewise. So the best way to get a hold of you, tell me one more time.
Well, it's just Jamie Miller at UBS. We have a team website. All of our contact info is on there. My email is jamie.miller@ubs.com. It's pretty easy to find me.
All right, perfect.
We'll search away.
Well, Google search away. Jamie, this has been awesome. Thank you so much.
Thanks, Randy. Thanks for having me.